So thank you all for joining in today. We're going to be talking about retirement plans and in particular how to use the customized questionnaires. The point we want to make is that VisionWorks is very scalable. Depending on your business model, you can do retirement plans for clients, let's say for those up to a certain net worth level. And then you can do a more robust financial or life plan for clients above that threshold amount. The other thing we want to point out, of course, is that each client's expectations are also very important. You may well have clients whose net worth is quite reasonable, but they say to you, just let me know, I'll be okay in retirement. So before we actually dive in and start looking at the questionnaires and their usage and so on, I just want to remind you that once you're logged into the website, you can roll your mouse over the VisionWorks logo, and everything that we're going to talk about today will be covered by the different videos. So you can see using the questionnaires video. When we talk about retirement plans, we'll be talking about the very basic plan today. Notice that video is just 14 minutes. As it proceeds through, it will reference some of the financial planning videos, primary account, how to enter portfolio data, how to create new solutions, those sorts of things. So this content isn't repeated in that 14-minute video. It's just an overview. The other thing that I'll just point out is that there is also the Getting Started Learning Guide. And if you don't have it, please let us know and we can send you a copy. So it talks about the difference between retirement assessment plans, retirement and estate assessment plans, some plan building notes that we think are very important, and then things like portfolio builder and presentation builder. So this document will help you get started. So let's talk about the customized questionnaires. The first thing that we want to point out is that we can customize these for you, and there are a number of ways that this can be done. You can add up to 2 logos across the top. You can see we've got a fictitious logo for a company we call Coastal Wealth Management. What we're also able to do is ensure that these colors match the corporate colors that are used in the logo. And if we scroll down further, we're also able to embed your email address in. I've put together another questionnaire, and just for illustration, I've used the VisionWorks logo. And as you can see, instead of a second logo to the right, I've put in my name and name, kind of a business card. One of the experiences we've had is that some dealers prefer that you do not use their logos, personal company logo, a business card, or if you don't have a personal company logo, your name, address, and so on, acting like a business card. I also want to suggest that you add a phrase like this. This is a text box. You can add different instructions to it. And I believe adding a little phrase about the submit button and the use of a password will help prevent any issues in the past or in the future. So let's look at these questionnaires. I just want to go through them fairly basically. When you send them out to clients, they get them, they can start putting in, personal information. You can also pre-complete some of this, but if you do, before you send it out, you don't want to save the questionnaire in the generic name, the basic questionnaire. What you want to do is you want to save it in your client's name. Somebody is telling me that there's no sound, but I believe that we should be okay. So, yes, Jeremy's confirming that we're okay. So you can pre-complete known information and then send it out to people, but just make sure that you save the questionnaire in the client's name if you do that. So a few things we want to point out. You'll see here it talks about general expenses, and there's a note. If people own a home, we strongly recommend that home expenses not be included in this general expense amount. And if people buy cars, including buying and financing them, we suggest that vehicle expenses be itemized in the vehicle. People lease vehicles, fine, they can certainly go in this general expense pot. And we'll talk about this a little bit more later. So then we can put in their salary, for example, desired retirement age. If we scroll down, you can see the area where people can put in the value of their home, property taxes, operating expenses. When it comes to vehicles, as an example, we drive a sport utility, we pay $40,000 for them. It costs us $10,000 a year to run the vehicle. And we want to buy the next one, let's say in 2022, and we want to replace it every 7 years. So all pretty easy to do. And then things like, what's the value of your TFSA? $30,000. What do you contribute? You could put in a dollar amount or just select the maximize button. What clients will eventually do is they'll hit the submit button. And the thing that I want to stress about this is that this is a PDF questionnaire. And yes, you could save the questionnaire, again in the client's name, and it would save showing all of that entered data. But what we want to do with this questionnaire is we actually want to extract the data from it in order to create a data file that can then be imported into VisionWorks. So one of the things we'll do in the customization is put your email address in the submit button, and then all the client need do is hit the submit button. They can enter a password if they wish, personal data flying around on the internet, and that's again why that introductory text box, I think, putting a note in there about if you wish to use a password, make sure you record it and send it to me. So then clients are given an opportunity to use Microsoft Outlook or webmail. So webmail would be something like Gmail or Yahoo. And so all they do is they hit the continue button, and by clicking that submit button, what happens is a routine is run that extracts the data from the questionnaire, let's say Bill's salary. And also there's, if you will, code in the background that tells VisionWorks eventually where to insert each piece of data that's extracted from the questionnaire. So one of the things that some advisors have struggled with a bit is they've saved the PDF questionnaire, but it's not the PDF questionnaire we really want. It's this FDF file. That's the data file that's extracted. So if clients send it to you, then all you need to do is right-click, click Save As, and then you can save that data file wherever you wish. Client record, for example. There is a space for that. If you look at Documents, Vision Systems, VisionWorks, Questionnaires, there is a folder where you could then save that FDF file. And my recommendation would be that you always save it in the client's name rather than some generic name. The one other thing that I just want to point out is there will be undoubtedly many clients who just don't want to complete questionnaires. So even in that case, I would complete the questionnaire with them or for them, because as we're going to see, there's a tremendous amount of efficiency when it comes to actually importing that data file into VisionWorks. One other thing that I want to point out is that once all the customization's done, your logo or business card, your email address in the submit button and so on, there is a freeze form button that will click, and it'll cause certain buttons to disappear. And I just want to come back to our coastal wealth. You can see the freeze form button. So once everything's customized, we click this, everything's kind of locked in. If we look at the very bottom right corner, you'll notice there's a button that says Load from FDF. So again, the FDF file is the data file. Now, once we click freeze form and these gray buttons disappear, what you'll see is that you have the ability, when that data file comes in, to run your mouse over the location where that button is. The mouse will turn into the hand pointer. And then what you're able to do is go and locate that data file the client sent you and load it into the questionnaire. And again, you would have to enter the client's password to decrypt the data. So the reason that I want to point this out to you is that this then gives you the opportunity to look at the data that clients have sent in, see that everything is entered correctly, so that do the import, you're confident that all the fields that you want to see filled out are properly completed. So let's see what happens. Client sent the file in, or you've done the work with the client, whichever. You're going to simply run VisionWorks. All you're going to do is click the Add button. I'm importing from a questionnaire. It's a retirement assessment. You're going to give the file a name. My preference is always something like Smith, Bill, Sue. I could deal with a lot of Smiths. Maybe something like RA, that stands for retirement assessment, as compared to, say, FP for financial plan. And then you could put in something like the date, because you may want to come back and, do some other work at a later date. So once we say we're importing, it's a retirement assessment, we give the file a name, click the OK button. All we need to do now is go and locate that FDF file, the data file, click Open. And again, if the client used a password to encrypt the data because it's flying around on the internet, you need to enter that password in order to decrypt the data. So once that's done, then everything is imported and the plan is set up. So I think getting started with these retirement assessment plans is tremendously efficient. So we can see Bill and Sue are imported. By the way, the life expectancy defaults to the FPSC suggested life expectancy, but you can go in and change that if you wish. And if we go down to entries, for instance, we can see that Bill's career income was imported. He said he makes $70,000. He wants to retire at 65. That's 2025. If we look at Sue, she also makes $70,000. She wants to retire in 2025 as well, her age of 60. And again, for example, if we go to the RRSP, we see that the value of the RSP was imported. And also, she said that she maximizes contributions, so we can see the contributions being maximized. So everything that was in the questionnaire is automatically imported. Everything is set up. One of the things that we do in the software is when we're talking about a retirement plan, we start off and we call it the initial assessment. In a financial plan, we call it the initial vision. You can, of course, go in and change the name to anything you want. You can also create unlimited what-if scenarios or solutions. Our recommendation is that you never touch the initial vision. Once you're satisfied that you've got the basic data entered, then what you would do is you would create a new solution, make changes in it. You can see there's a compare tab, so we would be able to compare the path the clients are on now with any new path, any new recommendations. But before going ahead and doing that, there is something that you can do if you wish. So if we keep in mind the client's question is, will I be okay in retirement? You may be busy. You may not be able to work on the plan for a few days or a week. And so one of the things you can do is give clients some immediate feedback. So in the initial assessment, there is a very simple little report that's built in. And if we click Print Preview, for a retirement assessment plan, it's just 2 pages. For a retirement and estate assessment plan, which includes insurance and estate output, it's 3 pages. And what it does is it says your general home vehicle expenses, you want 85,000. This is when you're going to retire. And then it produces a graph of the income assets forecast. There's an explanation here. If you click on the text, you can change it if you wish. But it just explains that the income assets are the assets that you will live off in retirement, like your open portfolio, TFSAs, RSPs, and so on. And then there's a line that says you are projected to have an income-producing asset shortfall. In this case, it's negative, or surplus, whichever the prediction is. So it's just very simple. But if we go to the next page, because this is a shortfall, what it does is it outlines things that clients can think about before you have that planning meeting with them. So they can think about downsizing their house, perhaps retiring later, targeting a higher return on investment, things of that nature. If it's a surplus, it will say you can spend more. If clients are already retired, it won't talk about retiring later. So any of these comments are very context sensitive. And again, you could click on any one of them and edit them. So this is just intended. And then what you can do, of course, is send them a quick PDF file. So this is just intended to give them immediate feedback. And if there's a shortfall, suggest some things that they can think about before the next meeting that you have with them when you really dive into the planning work. So let's go to solutions. And what we'll do is we'll create a new solution. And I want you to notice, by the way, if we look at the total forecast here, it's a complete disaster. And I've done this intentionally so that we can look at making certain changes and see what kind of impact we can produce. So I'm going to just click the copy button, and then we'll create an identical copy of the data in the database. And I'm going to call it your plan. And I'm going to select it as the plan. So let's have a look at some of the things that we can do. First of all, we talk about the importance of including the cost of vehicles in a plan. And very often this isn't done by other software. And I want to illustrate why I think it's really important, or we think it's really important. If we go to vehicles, you can see that they actually are two vehicle families. So they're working, perhaps they have children and so on. And if we just look at the cost of running a vehicle and we project it out to life expectancy at 95, what we see is that $5,000 of insurance, operating, and maintenance expenses, which is likely actually low, by the time they get out to between 85 and 95, we're running over $10,000 on average. So if we said 10 years of that at $10,000 a year is $100,000, and if we're taking money out of our RIF at the time to get the $100,000, we'll just say in round terms, we actually have to take $200,000 of income. So it's a big drain on the RIF, which may in fact not be happening. So in other software, it would be typical to put vehicle expenses into the general pot and likely assume that we're still driving two vehicles through age 95. So what we're able to do now is we're able to say, okay, well, let's look at the vehicle, and maybe Bill and Sue say, well, you know, we have two vehicles. I'm right-clicking to delete these. We only need the second vehicle, the car. We'll buy the last one just at the time we retire. And let's just say we drive it for roughly 10 years until, let's say, 2035. Sorry, I meant to bring something up. The shortfall originally, this is actually going to adjust, the shortfall originally was $2.3 million. And you can see it's actually already down to 1.9. So I need to make this adjustment, get rid of the future operating expenses for the vehicle. And then what's going to happen is the original $2.3 million shortfall is now just going to be roughly 1.8. If we do the same thing with the sport utility, so I'll bring the income assets up this time and say, well, we'll buy the last one in our late 70s, and let's even assume that Sue drives until she's 90, which is 2055. See that by being a little more sensible about the vehicle expenses overall, what happens is that the $2.3 million shortfall is now only about a $1.5 million shortfall. So that just illustrates how impactful vehicle expenses are on a plan. And if they're thrown into the general bucket, the assumption easily is we're still driving 2 cars when we're 95. So we want to be a little more realistic about them. And also, I think by starting with this, what it's really saying to the client is this isn't just all about portfolios. This is about, lifestyle decisions and so on. What I want to do next is I want to look at reallocating. So one of the things that you will need to do, and it's in that getting started document, is you will need to understand how portfolio builder works. So you'll notice in this case, and this was in the questionnaire, what do you think you've been earning in the way of a return? I actually kept that number low at just 3% so I could better illustrate things. So I can go in virtually any year in the plan and do a reallocation. But in their case, because the return is so low, what I'm going to do is I'm going to reallocate the portfolios. This is now referring back to portfolio builder. And what I'm going to do is I'm just going to use one of the 4 strong portfolios for illustration purposes. 6% total, 5.2 net. And I could apply it to different portfolios or select apply to all and apply to all of Bill's portfolios. And of course, what we're going to see is a very dramatic difference. So again, this is the kind of thing that at some point you can learn to do live with clients. So we can see that from a $155,000 shortfall, it's now actually a $500,000 surplus. The impact on Sue is later in life after Bill's life expectancy, and then we can see that as well in the total. So we still have a fairly healthy shortfall. So at this point, we've created a new solution. We've just been a little more sensible about the vehicle expenses. We've reallocated Bill's portfolios only. And one of the other things that I want to show you is on tactics, we can now go in and apply some very interesting tax tactics. So as you know, couples can transfer certain tax credits between each other, donation tax credits, medical expense tax credits. In this case, we haven't itemized any of these. They can also share CPP, a one-time election, and they can also split pension income, which can be done year by year. So what is going to happen here is we're going to click the Optimize button, and the software is going to go through and try all possible combinations. So if there were an expense, it would try only that, transferring the credit to the other spouse. Then it would try donation and medical. Then it would try donation, medical, and share CPP. So it takes a bit because it's going through trying all these different combinations. And then what it's going to do is it's going to tell us what the optimum combination is. So we have to allow this to process for 30 seconds or so while it checks everything out. By the way, the speed slows down with Join Me Open. So we can see that the optimum for them is sharing CPP, splitting pension income. They'll save taxes of about $26,000. They'll reduce OAS clawback by about $8,300 for a net impact of $34,000. So these are some of the things, again, that you can do with clients and do them live as part of showing value. What I want to do next is I want to bring up the document that you should all have, the PDF file that you should all have, called the 3 C's in the 5 main plan theme. So if you notice, if we go to total, the net worth in this plan looks fine. We're talking about net worth being the house, the cottage, TFSAs, RSPs, etc. But if we look at the income assets, just open portfolios, TFSAs, RSPs, the assets that produce an income, we see that there's a shortfall. So this is the theme we call house rich and cash poor. And the whole objective, of course, when we're happy that we've got the entries in there properly, is to be able to understand what is the client's core theme. And the core themes, there are only 5 of them: house rich, cash poor, for example. And then other themes are things like high latte factor. People are underestimating their expenses. They're okay with their income, it's salary, but they're underestimating their expenses, which gives them a the software projects a false savings capability. And then other things like high net worth. So my suggestion to you is that if you're dealing with the mass affluent to higher net worth client, they're likely going to be okay in retirement. That's not their core issue. So if we're just doing retirement plans saying, yes, you'll be okay in retirement, comfort food, but nothing that's particularly, earth-shaking for them. The problem with clients who are in that category is simply that because they have wealth, they likely can have an estate issue, such as not enough liquid assets in order to pay all the terminal charges, be they income taxes or estate administration taxes. So if you're dealing with the mass affluent to high net worth client, it's this high net worth theme, the estate gap theme, which is really their core theme. So what we want to understand, what are the key issues? What's the theme for the couple? And we've seen in our little sample, it's house rich, cash poor. And then what we want to do is we want to apply the 3 C's. So the 3 C's are convert, downsize a home, for example, sell a business, create, which can be portfolios, but it can also be career. And I always use this example with advisors because you're trying to build wealth based on your career. It's not just about portfolios. Clients who are self-employed or have their own business and they're trying to build their wealth through their business. Conserve is spending, highly appropriate for the large latte factor theme. We did a bit of that sort of conserve when we talked about vehicles. And then, of course, a special conserve, which is reduce income taxes. And this should be pretty much in everybody's plan. Nobody wants to pay the government more than they need to. So if we look at what we did today, what we did was we reduced the vehicle expenses, we reallocated the portfolio, conserve, create, we reduced income taxes, that special form of conserve. So understanding the theme is then applying the 3 C's. We still have a shortfall. So what I want to do now is just go in and apply the convert theme. So I'm just going to go in. I'm going to say, well, either out of necessity or because we overhoused ourselves and didn't save enough, out of necessity or out of choice, we want to do a lot of traveling. It's going to be more convenient if we have a condo. We won't need the big house at some point. So I'm going to go in and sell the house. It's worth $500,000 today. So given growth, it's about $839 in real terms. That's real growth. So I'm going to sell the house in 2030. Bill will be $70. And what happens, of course, automatically is that the value of the sale goes into the non-registered portfolio. And because it goes into the non-registered portfolio, we've got a great big boost in the value of the income-producing assets. We don't have that problem anymore. But we do need to offset that with the purchase of, let's say, a condo. So we'll create that. And then we can go in and model the purchase of the condo. And notice I'm actually making it 1 day later just because of 2 principal residences at once. We sold a house, that was worth $500,000. We're going to, of course, appreciate the condo, but we can talk about it in terms of today's dollars. and you can see that it's appreciated in the background. And I'll make that the principal residence, and I can even include land transfer tax. So that's going to take some money back out. But what if we have a look at the income assets forecast, what we're going to see is that we've actually skated everything on side. So we started with a file that was $2.3 million negative. We were sensible about vehicle expenses. We're not driving 2 cars when we're 95. We reallocated only Bill's portfolio. We applied some tax tactics, and in this case, we downsized the house. So we covered the 3 C's to correct the house rich, cash poor theme. What we're going to do next week is we're going to have another look at those themes, and then we're going to relate, given the 3 C's that we applied in a plan or combination of them, what should we do in the way of reports? What are the sections that we should include in reports? Before I finish up, I just want to show you a few things. When we imported everything from the questionnaire, there were certain generic terms that were used, like owned home and owned vacation home. But my recommendation to you is that you personalize the plan a little bit. So I can go in, right-click on owned home, and then anything that I want to right-click on, I can click Edit Text, and I can change that and personalize it. So I'm just going to call it 6 Hour Street. And then similarly, I can change own vacation home to, something like cottage. So it just makes it more of a personal plan. The other thing that I'll point out is that we were using general expenses of $50,000. And you'll notice what happens here. This is 0 up to retirement in 2025. So I would like to just explain this to you. There are only 2 things you can do with money. You can either spend it or you can save it. And by save, I mean save in an open portfolio, contribute to a TFSA, contribute to an RSP. So what the software does is it says, what are you saving? What are your contributions to your TFSA, RSP, for instance? And other than the home and vehicle expenses that we wanted to itemize for specific reasons, what the software does in the background is it says, well, if you're not saving this money, then everything else we're just going to assume is spent. We don't care where you're spending it, it's just spent. Once you hit retirement, however, we need to know what is it that you're going to be spending, and we need to know this, of course, because we need to know whether or not the money's going to last. So, what are you going to spend in general? What are you going to spend on homes? What are you going to spend on vehicles? This can include vacation expenses, but I would suggest to you that itemizing those separately might be a very good idea. And the reason for that, of course, is that things can change over time. So we spend $3,000 on winter vacations today, but come retirement, when we have more time, considerably more. Let's make it $10,000. And we're not spending $10,000 when we're 95. Let's just do that for 10 or 15 years, maybe drop it back down to $5,000 for 5 years or whatever. So if we want to itemize things like this, we could then go into general expenses, and we could reduce that $50,000 by what we thought we would be spending on vacations, the $3,000 or whatever. The other thing that I want to point out is if something has a tax implication, I would absolutely separately itemize it in the plan. So if we look at net cash for a moment, what we're going to see is that we can do, or the software automatically in the background does a tax calculation. I'm going to go out to the retirement. And if we look at Bill and his income taxes in his retirement years, we can see OAS, CPP, etc. His RSP deduction, he just retired in 2025, as you'll remember. Age amount, notice nothing here for charitable expense and nothing in the way of a charitable expense that was transferred to Sue. So if we go in and we're dealing with a couple, for instance, for whom charitable giving is very important, let's say a donation to their church, what I want to do is I want to separately create that, and then I'm going to go in and make that $5,000. And I'll even say that's over the course of their life, that charitable giving is very important to them. So having itemized that, because there's a tax implication, what I want to do with general expenses is I want to go back and I just want to reduce the general expenses by the amount of the charitable giving. I'm not going to, be precise here. We'll just make this, roughly the 45,000. But the reason we want to do this, of course, is if we go back to net cash and we have a look, what we're going to see is that we have the charitable donation tax credit operating in the background. So that's, a significant factor when it comes to our actual taxes. So now if we look at Bill, we can see we have the donation tax credit. And we have to keep in mind that that's going to apply over the course of his life. So it'll be a significant savings in tax. So once again, when it comes to doing retirement plans, while you can work with general expenses, anything that has a tax implication, I would encourage you to itemize it if you can. And anything that involves something that can change over time, like winter vacations, again, you may want to itemize these and adjust general expenses accordingly, simply because some of these expenses aren't going to persist into our 90s. So those are the things that we wanted to cover today. In particular, if you don't have a set of customized questionnaires, what we need from you is a decent resolution copy of your logo. Check with any dealer or your dealer to see if they would want you to include your logo. In some cases, we found that dealers don't want that. So it could just be your logo plus a business card. If you don't have a logo, personal company logo, we can just, add a business card look to the top right. So we'd be happy to get all of these, happy to get all of these customized for you. So what I want to do now is just go into talk mode, and what we'll do is we'll throw things open for questions.
The conference is now in talk mode.
Everyone can talk now.
Questions that you would like to have us address?
Michael, I sent you a chat message about that I had cleaners in my office for about the first 10 minutes of the presentation.
Oh.
Will it be recorded, and is there a way to re-watch it, and also so that I could make some better notes about the things you went over?
Yes, Jeremy is recording it now, as a matter of fact, and what you will see when you go to our website is that, and this can take a couple of days before it's posted, but in the upper right corner of our website, you'll see, for example, the YouTube to our YouTube channel. And assuming everything got recorded okay, you'll see this is where we have lots of different videos listed. This is what are and why life plans. Oh, sorry, that's already started. Let's get out of there.
Okay, that's perfect. Thanks very much.
You're welcome. Good question that came up. The question is, we'll have to open up our retirement assessment plan. Very excellent question. So if we go to the tactics, what you'll see here is for the splitting of pension income, there's a checkbox that says for tax purposes only. And what that means is that when we split pension income, so whatever the result was, let's just say some of Bill's pension income is, now being taxed in Sue's hands, we now have Sue's income taxes. So Sue's going to be paying tax, that's a, cash expense on the split pension income. If you were dealing, for instance, with somebody where you had one person in the household working, the other person was, a stay-at-home parent, the stay-at-home parent may not have much, if any, income. So what we want to do is we want to split the pension income for tax purposes, but not for cash flow purposes. For cash flow purposes, we want the person who is earning that income to actually pay tax for both parties. So this will split it for tax purposes, but keep one party paying the full tax. Again, this will take a bit to work through. So I don't know if we can find a year where we might see this being applied or not. Let's have a look. So are we getting any split income here? No, we're not getting any split income. We'd actually have to find a year where there is some split income. And then you'd see that Bill or Sue would be playing both. Jeremy suggests that you may be able to see that actually on the spreadsheet. So notice that I've been using the graphical form of output, but I can switch to the spreadsheet and also expand it to the full screen. And then we can go down and have a look at who's getting what and whether things are being split or whatever. Yes, you can see here the spouse's income taxes. So what we're seeing is that Bill is splitting pension income with Sue. Sue would have in this year $116 of income tax to pay, but Bill, we're on Bill's tab if you'll notice upper left, but Bill's actually paying the tax that Sue otherwise would pay. So it's for tax purposes only. I was also asked a question about why no ACB on the questionnaire. And the answer to that is very simple. We want to keep the questionnaires relatively easy for people. We don't want to, make them too challenging. If you ask what's your portfolio worth, and then turn around and say, and tell me B is, right away, there's a good chance that not too many of those questionnaires are going to come back your way. So we want to keep these questionnaires light and just use them to get things going. So actually, just to further this thought, I have a little cartoon that I really love. And I'll just bring it up. As you can see, somebody is standing in front of a storefront financial planning, and then the signs on either side are rock and hard place. So we've got to remember that people's perception about planning often is not very favorable. I'd rather have a root canal. And that may be because, you're going to give me bad news, or it's all about, portfolios. You're just going to try and sell me product, or retirement's one day, someday. And so I really don't think I'm going to get a whole lot of value out of it. So I don't want to spend a whole lot of time on this. And that's why even higher net worth clients who should take a deeper dive into planning, that's even why sometimes they'll say, just let me know, I'll be okay. So the idea is we want to be able to get people engaged in the plan, show them that we can actually produce some value, show them what more is possible. So we don't want to overburden them at the beginning with a retirement assessment with, too much information gathering. We want to keep it pretty simple. Ultimately, of course, the idea is that if clients are, good clients worth spending more time with, once we've got them engaged, then what we can do is we can take that retirement assessment plan, click the edit button, and say, let's convert this to a financial plan, and literally in a couple of clicks, we can upgrade it. One of the other things that I want to show you along this line is if we've got the financial or retirement plan questionnaire completed with, name and date of birth and all those sorts of things, I can actually open a financial plan questionnaire, which has more detail, on things like lifestyle expenses or family expenses. I can actually open that, scroll down, do a load from FDF, go and grab that retirement data file, and I can open it up into the financial planning questionnaire. And as you can see, I still have bill, sue, dates of birth, and so on from the original questionnaire, salaries, desired retirement age, etc. And then the client could go in, for instance, and simply say, well, let's add some more things like a restaurant expense. And then if we go in and we save this file, and I think I've done one before, so I'll just save this. I think I've got one in here that I can just quickly overwrite. There's a little financial planning file, so I'm just going to overwrite that. And then what I'm able to do with my financial plan is I'm actually able to go to Questionnaires Import from Questionnaire, go and locate that financial plan file that we just saved, open it up into the existing financial plan. I still have my home, condo, cottage, all the things that we did before, but what you'll see is now I've also got a lifestyle, entertainment, go to restaurant expense for $25,000. So there's a lot of flexibility in these things to start with a retirement plan and then upgrade to a financial plan, not lose any data, even populate the financial planning questionnaire, and then just use the lifestyle and family expense sections to grab a little extra data from people. You'll have to forgive me, there was another question that came in, but I missed it. Oh, what were the limitations of a retirement plan compared to a financial plan? So a retirement assessment does not deal with insurance and wills, and therefore the estate. A financial plan covers those. A retirement and estate assessment plan does deal with wills, does do insurance, but it ignores expenses other than, your contributions to TFSAs. It ignores expenses up to retirement. It assumes everything is being spent. And I'm going to suggest to you that ultimately where you want to go is a financial or life plan, because it's going to look at expenses not just in retirement, will we be okay, but it's also going to look at current expenses. And I'll suggest that I don't know very many people who sit around the dinner table and talk about whether or not their retirement plan is on course, or whether they need more critical insurance. They talk about things like, let's renovate the kitchen, can we afford to, how much can we afford to spend? Sue wants to spend $75,000, Bill wants to spend $10,000, et cetera, et cetera. So retirement plans don't help people answer the questions that I actually think are more pressing for them and of greater interest. Can we afford to renovate the kitchen? How much can we afford to spend? So when we get into a financial plan or life plan, we're looking at expenses throughout the course of their life, and we're able to help them answer these questions. And I think that's a very important value add. Other advisors can't do this nearly as well as the life model that we've created can. There was also another question that came in about DBPs. A retirement plan will flex right up to a full meal deal financial or life plan. There's absolutely no limitation. So we've already converted this, but absolutely you would still have the ability to go in a retirement plan and create a DBP, or you'd have the ability in a retirement plan to add rental properties or stock options or employee share purchase plans. So one of the things you have to understand is that we always started and always took the view that we wanted to produce very robust software. There was lots of retirement software in the marketplace, but the truly robust software was, what was missing. But what we did starting about 3.5 years ago was we decided to scale VisionWorks back to be able to do these kinds of high quality retirement plans. But in scaling back, we didn't lose any of the key functionality. We still do income taxes. We still calculate wills or the estate output in a retirement and estate assessment plan. We still have the ability to model rental properties. So there's no loss of functionality in a retirement plan. Any other questions that anybody has? Okay. Well, I want to thank you again for your time. Again, everybody should be able to do these plans very easily. You're going to have lots of clients who say, just let me know, I'll be okay. So let's make this a good jumping off point. And then from there, we can upgrade it to a more robust plan if we can, get clients engaged. And part of all of that, I think, is that you need a set of customized questionnaires. They're yours. It'll give a nice branded look, and you won't hesitate to use them. Keep in mind, again, that a lot of clients won't complete them, but you can complete them with or for the client. You can print them and just, complete them paper-based, get back to the office and enter it into the electronic version. Do anything you want to do along that line. But I think you'll find once you start using them that they're very efficient to use. So thank you again for your time. We'll hopefully be able to post this on YouTube. I'll send something out to that effect if the recording went okay. And if you have any questions or want to get the customized questionnaires done, just let us know, and we'd be happy to move forward with them. Thank you again for your time, and have a great weekend.